I like it. It gives me peace of mind, and that's the mindset shift.
What would it look like if somebody used the all-in-one system to maximize cash flow efficiency?
Both of the tools together to create that looping effect.
Welcome to Montana Whiskey, Wealth and Freedom.
Well, I've been in love, I've been on the ground, I've gotten back on my feet, just to fall back down on my knees for you and your whiskey under the bridge.
So the title of the episode is Stop Losing, Start Looping. Instead of losing money unnecessarily, start looping money intentionally. That's what we're going to talk about today.
Cool.
Yeah. So kind of interesting, just for the table, have you ever, this is just more of a rhetorical question, but have you ever thought about a bank's floor plan? Considering that banks have two primary functions, an intermediary function and a lending function. And for whatever reason, at 3 o'clock in the morning, a couple nights ago, I was thinking about a bank's floor plan. And I was like, every bank is pretty much the same, designed the same way. You walk into a bank, there's a counter that you walk up to for your intermediary function, the depositing cash, withdrawing cash, whatever. But then always around the counter are offices. And those offices have lending officers that you go in and sit down with. And so you have the tellers, and then there's separate offices that for the lending function. And so I just thought that was kind of interesting because I just never stopped and thought about the actual floor plan of a bank, that both of their primary functions, business functions, are designed or laid out that way as a floor. Separate, yeah.
They're separate.
Yeah. So the opening bold claim of the show, most people are trained to go to the counter to store their money, and then they walk over to one of the offices to borrow it. What if that bank is the very thing slowing down their financial life? So Kellyanne, in your opinion, what's broken about how people traditionally manage cash flow inside bank accounts?
Yeah, I think that to speak about the floor plan a little bit, this is just kind of an interesting anecdote, but I recently went into the new Clearwater Credit Union in Butte. It was just recently built and finished, and they do not have a counter, which is interesting. And I've seen that Capital One commercial where it's supposed to be more like a cafe than a bank teller. So I don't know if they are changing with the times a little bit or having to cut the fat. I know some national banks have actually gotten rid of in-house mortgage departments and loan officers in every branch and things like that. So I guess to answer your question, I think that most people deposit money and sort of never think about it again. Maybe not most people, but for a lot of people, I think they do their typical, deposit their paycheck into their bank account, pay their bills, make sure their balance stays up above a certain amount typically, but don't ever really worry about it or think much about it past that.
Okay. And then Kyle, on your side, what's broken about how people access capital through traditional lending? And these can be somewhat pithy answers because we're going to delve much deeper in the show into both of these cash flow and capital access topics.
Yeah, I think that regarding the floor plan, it's also the amount of bodies. How many people are telling versus how many people are lending. Their lending department in a bank is the most important department. And
it's always at least double the amount of tellers they have.
Usually 3/4 the size, like a quarter would be telling in banking versus 3/4 would be lending. And so they're always looking for those opportunities to go, put cash in motion.
Mm-hmm.
And because we think of the bank as our only option, the bank that we know, because we've got friends that work there, or it's the biggest, nicest building in town, or whatever it might be.
Or the coffee shop.
Yeah, right.
Exactly.
Cafe. But that's where money is supposed to be. That's what we've been taught, save your money here. You have all these different options. Well, then how then do you access it? And you access it based on their terms and their rules. yeah, you can go pull your money out. But if you need anything more, if you want to use OPM, for example, you've got to play by some serious rules. And those rules are changing all the time. The market conditions are changing all the time. And so what's broken about that? It's not quick, it's slow, and it's hard to maintain leverage when you're playing by someone else's rules.
Love it. Thank you. So by the end of this episode, the question is will we be solving two different problems or the same problem from opposite sides of the bank building? So I'm just encouraging people to stick around and find out, because hopefully by the end of the conversation, we're going to be able to answer that question. So quick intros. To my left, Karen Goff, certified liability advisor and mortgage professional with CMG Home Loans. Welcome back, honey. So, it's just funny because she always has to be here. Across the table is Kyle Reese, an agent with Create Tailwind and an IBC Infinite Banking Concept professional and practitioner. And then next to Kyle is Kelly Ann Hoven. So you have a new realty broker relationship that we need to hear about, but you are also an all-in-one loan practitioner.
Yes.
Which makes you a very exciting person. So, first question, before we learn more about your new broker relationship, have you ever actually heard of the infinite banking concept? Are you familiar with it?
I am not.
Interesting.
But he said OPM, so I knew there was going to be something.
So one of the reasons why I was excited about having Kelly Ann come in today is that she is, but again, we did one other show with her, and it was very clear that she's somebody, not only her, but her husband and her father, and they have an aptitude or an appetite for thinking out of the box, for really being open-minded and exploring opportunity where they can find it. Is that fair or safe to say that?
Or taking advantage of an opportunity when it presents itself.
Yeah. So I thought she'd be a great person to have as part of the fold of this conversation. So please tell us about your new situation.
Yes, I recently moved offices. So now I'm a realtor with Berkshire Hathaway Home Services, Montana Properties at the Butte office. And it's been great. There's about a dozen of us gals over there, and they are all very motivated, very eager, very involved. And it's been a great energy to start the year out with.
Excellent.
Yes.
Right on. Well, I want to hear more about it. We're going to definitely make sure to spend some more time talking about that before the end of the show. But I just wanted to at least have an opportunity to hear about your new prospects.
Yes.
Yeah,
yes.
Cool. All right. So the whiskey moment. Let's real quick just touch on what we're drinking and what we are promoting for the first quarter of the year, 2026. We've got the Million Acre Bourbon. We've got the Tobacco Root Mountain Rye Whiskey. Kelly Ann, could you please point to the bottle?
Yes.
Do like a
Vanna White.
Vanna White, yeah. And then in the center we have Devil's Brigade whiskey, which is actually the one that's being promoted this month. It's still March, right? Mm-hmm. Yeah. So for the month of March, that's the Devil's Brigade whiskey that we did the show last week on, and anybody that wants to purchase these products, they can go to the Treasure State Advisors website or to Willie's Distillery directly and purchase the product using the promo code TREASURE. And if they use that code, then they can get free shipping on the 3 bottles. You have to order 3 bottles in order to get the free shipping, or you can get 15% discount off of all merchandise. So what is everybody drinking and what do we think?
I'm drinking the Tobacco Root Rye because we've got a cabin in the Tobacco Roots and I haven't tried it yet. So I figured I would.
And what's your thoughts on it?
It's delicious.
So of all you've been here, you've had quite a few of the different products. The Stockman's Rye,
yep.
This rye, the Million Acre Bourbon, the Bighorn,
Moonshine.
Moonshine.
Yep.
So is there any one in particular at this stage of the game that's standing out as a favorite to you?
Million Acre.
Seriously? Is that still the winner, huh?
Yeah, 100%.
Okay.
And that's what I'm
It is 100%.
Yes, and I like it. It's much nicer than.
And that's what you're drinking. You're drinking the Million Acre Bourbon.
I am.
Yeah,
Mm-hmm.
yeah. It's
It's smooth. It's rich.
I was going to say it's probably dangerous.
Yeah.
That's right. I forgot.
It's too good.
You like it because of it's rich.
Yeah.
And you like everything that's rich or anything that's rich.
Yeah. Or anybody that's rich.
Right. That's what. Right. What are you drinking, hon? We're both drinking the same thing.
Yeah, I'm actually drinking the bourbon whiskey. I absolutely love the tobacco rye, but we need to get another bottle, and so I wanted to make sure our guests could try it because they hadn't yet. But but I have the bourbon whiskey and the moonshine. Both made me actually figure out that I am a fan of rye. It has a lovely spice note that I really enjoy in things, and so it's in all of them.
This is kind of fun, little fun exercise. Think of your money like whiskey being distilled. You start with raw ingredients, which is your income. But if your system has leaks in the still or the condenser, the final spirit, i.e. the usable cash you can actually deploy, is less than it could be. Most people are losing money at every stage without even realizing it. True?
I would agree with that.
True.
True.
So that's the whole reason why the name of the show, or episode is Stop Losing, Start Looping. So, rhetorical question. If cash flow is like water pressure in a system, where is it leaking in the mortgage world and where is it getting blocked in the banking world? So moving on to the wealth principle. Speaking of cash flow control first, Kellyanne, how has the all-in-one loan changed the way money moves through your life?
I am really enjoying the all-in-one loan because instead of making individual transactions towards our mortgage balance, making a payment or an extra payment or applying your tax refund. I know that's a popular thing to do, to just throw that out your principal balance if you can. What's nice about the all-in-one is it's all of your cash flow goes through that account. So it's the money that you wouldn't have even set aside to pay towards your mortgage is working for you against the balance of your mortgage. So it's you'd lose nothing, essentially, is what is nice. There's nothing that kind of falls through the cracks unless it's not associated with that account, moving through that account. But
yeah, the beautiful thing is it manages to take idle monies that would normally just sit stagnant doing nothing, and it makes it useful where it's saving you money until you need it. And the second you need it, it's there, but it's saving you money all that time in a super efficient. It removes all the friction of traditional checking accounts or mortgages and all these different things that silo the money.
Right.
Where have you seen the biggest gains? Do you feel like it's been an interest savings, liquidity, or behavior change on your behalf?
I think it's been a mindset change, to be honest with you. It's really nice to see that balance go down. I know we talked a little bit about momentum. So you can see as there's more money flowing through your account, the balance you owe back is less and less, which also means that you have more available, which I think for some people who maybe aren't as disciplined or have trouble, saving things for a rainy day, perhaps, that could get you into trouble. But I like it. It gives me peace of mind. And that's the mindset shift is, it's one less thing to look at separately, right? And then, like she said, even if it's earmarked for another bill to be paid or something, until that bill is due, it's sitting there working for me to offset that mortgage balance. So I really like that because I feel like it takes a little bit of a load off of my, mentation about paying bills.
Well, and the nice thing is, that's why it is a significantly more significantly more of an underwriting process, because we're making sure that it's the person who is the saver type, who is the person who's responsible and is going to be that, versus the person who's just going to rape all their
Blow
equity out
through
of their
it, yeah.
out of their property. And yeah, so that is, but for that, when all of a sudden you can see the money that otherwise would just be sitting there in a bank account because you need it in 6 months, 9 months, a year. God, but what can I do with it? I need it at that time. Now, all that time, it's holding your balance down and therefore holding your interest down.
Yes.
So shifting over to the capital access control, Kyle, at its core, what does the infinite banking concept solve that traditional lending cannot?
The fact of the matter is that we finance everything we buy. We either lose money to other people, other banks or whatever, by paying them interest to use money, or we lose the future opportunity or the opportunity cost of capital if we pay cash, right? So as soon as we pay cash, that is gone and it can never be anything else. So we're losing one way or the other. And so that is what we're taught to do. You either pay cash, do the Dave Ramsey way, or you borrow other people's money. Either way, you're experiencing loss.
Why is this is just one component of it, but why is uninterrupted compounding such a critical piece of the strategy?
I mean, if I could have interrupted compounding or uninterrupted compounding, my choice would be uninterrupted compounding, right? Because it doesn't matter whether I'm using I'm using policy loans or I'm going out and deploying capital from a banking system that I own and control. It doesn't matter how much I do that or how little I do that. The money in that system is going to grow regardless.
There's a great visual that you probably have somewhere that I love, because it just for people, whether or not pay cash or borrow, but then there's a third option, right? The third better way, which is borrow from yourself in your own way, because it shows, okay, most people borrow, so I'm going to go up buy a car and I'm going to take a loan out for it, and then I'm going to pay it back, and eventually I'm going to be at base again. Or I save for the car, so I'm saving, but then I bought the car and I'm back at base again.
Yeah.
And so the thing is the beautiful way of, well, yeah, but what if you could start stepping that up in a way that you are ultimately moving your position because it's borrowing from yourself and that asset is still growing.
And you said borrowing from yourself. I'll push back on that really quick, because we're not. And that is what so many people get wrong in this idea, is that we are borrowing money from ourselves and we're paying interest to access that money. No, we're not. We're borrowing money from a life insurance company designed as a mutual life insurance company, and as a policy holder of that company, I am a part owner of that company. And so when I borrow the life insurance's capital to go do what I want to do over here, my money still is over there. Like, I'm not taking any of that out. I'm borrowing OPM and my asset is being collateralized, but it's on my terms. It's not on anyone else's terms.
But if it's a mutual company, because you bring up a good point, and so therefore you are effectively a principal shareholder of the company.
Correct.
It is your money.
It's the money of an entity that I own and control. That creates a degree of separation. The degrees of separation is you guys were talking about the all-in-one loan, which is kind of combining stuff, right? With the banking process, we try to make sure that it's separated in the way that we think about it only. Because when we're borrowing from an entity that we own and control, it makes sense that that's business ownership, right? That's a banking ownership part of it. Then we're stepping over and playing the role of borrower. So bank owner and borrower, yes, it's the same person. I own the bank and I am the borrower, but I'm borrowing from a separate entity. And that distinction is really important because it changes the way that you think of yourself as a borrower.
Would it be fair to say that it's essentially two different buckets? So you're collateralizing your own bucket of cash value, but the actual loan that you're receiving is actually coming from a distinct and separate bucket, a
100%,
general
yeah.
account. So that's why your account balance is able to compound uninterrupted, because it's not going like a typical savings account. If you were going to do a major capital purchase and you withdrew money from that account, now you've lost the opportunity to earn interest on the money you just withdrew.
Right.
What you're saying is that if in the infinite banking world, you are able to maintain full growth opportunity on full account balance in your bucket while you're borrowing against it from the general account of the mutual insurance company.
Right.
So I'm going to step back on myself, even though I just said we're not going to do the one-on-one stuff. It just occurred to me, I'm being a little unfair to Kellyanne because I asked you the question, have you ever heard of the infinite banking concept? And you said no. So here we're having a conversation about the infinite banking concept. And it's like, she's going, wait a minute, what the heck are we talking about here? So I do apologize. I didn't think that through, but I do think maybe we should take a step backwards. If you would like, I think it's totally fair to say, let's take a beat and let's step backwards and actually have a little bit of a quick kind of one-on-one conversation, just so you can bring you into the fold.
I think I get the general idea based on what you were saying and how you summarized it. But
so, Kyle, please just for Kellyanne's
really
benefit.
high overview. So
Yeah.
every bank, they have depositors and they have borrowers, right? And right now we're playing depositor to someone's bank and borrower. Well, there's three players in the play. There's depositor, owner, and borrower. And we're losing money in that process because they're giving us, 0.2% or 0.02%. They're giving us nothing. And they're out lending that for an average of 5.2%. So they're netting a great amount of money because they're playing owner. And so infinite banking really is just building a wall around all of that and helping people become owners of banking systems where they're depositing into those and then playing lender and then also playing borrower. So it's playing all the roles within one system of banking, of money.
And
Very cool.
the concept is something that is, because it's a concept, it's more of a philosophical behavioral process or strategy that can be used with any kind of account type. But specifically what Kyle's talking about, would you mind giving her a little bit?
Yeah, no. So whole life insurance policies are used as the banking, as like the holding facility.
Sure.
Because of their unilateral contract nature and the solidity of the insurance companies themselves, proving profitable for over 100 years. You've got, did you know this, you guys? So a bank has on average about 7% of their liabilities ever on hand at any given time. And it's oftentimes way
Of their
lower
assets.
than that. Yeah.
Yeah.
Very, very low. So they're inherently illiquid.
Yeah.
Life insurance companies are required to have 107% of their liabilities on hand at any given time. The
Because if somebody kicks it, they have to pay it out.
the carriers that we use have 112. And so what that means is if everyone in their, every single one of the people that they've got policies on was to croak at the same time, they'd still have 12%. That is
Make
insane.
payroll.
Right.
That's insane.
Yep.
That's great.
So the level of solidity, the level of liquidity that they have, the control, like it is unreal when we compare that to the rest of the financial world. So we say, why not own that? If you have an opportunity to own that and store your money there and access it in an uninterrupted compounding way with unilateral control to take opportunities as they present themselves, why would you not do that?
It makes a lot of sense because I was taught from my dad, if you put money in the bank, they're going to use your money either, and they're making money off of your money. And like you said, we don't get any, pennies back maybe.
Yeah.
So it makes sense to me that, why not be the one that's doing that?
Right.
You want to hear something sick? So if they're paying us 0.2% and they're making 5.2%. Well, let's apply dollars to that. If you put in $10,000 and they go deploy that and they make 5.2%, that's $520. And then they'll pay you $20. So how much better did they do than you did?
Right.
How much?
$500 more.
Unless you're thinking like a business owner, because 20 goes into 520 26 times. So they did 2,600% better than you with your money.
But
No, thank you.
that's the thing that suddenly becomes fun, like you were talking about before, where for you, like you had a house, so you were in a position like most Americans are, you needed a mortgage to first do that. And then you had equity that you wanted to tap into, so you had a line of credit, and then you had this bank over here, and there were all these things you were managing, and it was all siloing off your money. And now you get to have a way where you still have the house, but there's no more idle dollars. The bank isn't getting to make money off of you. It's saving you money the whole time it's in there because it's actually doing something. So that's really fun.
So I have a question about that all-in-one loan. With the all-in-one loan, yes, the money's in there. You're saying the bank is not making money off of it.
Well, I mean,
Okay.
you are their banking client. And so anything that's happening there. But what I'm saying is it's not like the bank has that money to go loan. It's sitting there now holding down your loan balance.
But
So it's lowering your debt.
You're asking
but
if
they're leveraging that, right?
are they loaning those? Are they loaning your account balance out to in a fractional reserve basis for lending
Right.
purposes for other reasons?
They are immediately sweeping over when you deposit your money. It's sweeping over and lowering your loan.
Yes, it's lowering your loan, but it's because you're increasing the amount of money that's going against your account, right? And they're able to use that capital, like it's still in there, but they might be leveraging it, fractionally reserve, lending it out because it's sitting there.
Well, because they have less of a liability now on their
Yeah,
side.
right,
Because
exactly.
If your liability is lower.
Yep.
Yes.
So it is profitable for the bank.
Yeah.
To do so. Yeah, right.
But it's not in the same way. It's not like in the way you're talking about. At least you got to get a benefit of it. It's not like you gave them their money and then you're making whatever percent. Whatever your rate happens to be, like that's the amount daily you're saving for any time you can let those idle dollars sit there. That you are saving it. Literally, you are saving
Yeah,
it
because you're not paying interest.
because you've exactly.
Yeah.
And so therefore you're saving. And so even if again you can't, the beautiful thing about it is it uses idle dollars, not investable dollars, because stuff you would still want to go invest somewhere that it made sense for you. It's all the things that, well, my car payments I got my paycheck today, but my car payment's not due to the end of the month. Well, I'm making my money, but my property taxes are only due twice a year. My homeowner's insurance is only due once a year. If I'm self-employed, my quarterly taxes are only due. But where can I put that money that it's saving me all that until I happen to need it? Because I need this thing or I want this thing called a house that I live in anyway, that I get to use and
Right.
still be able to manage. Basically, mortgages are the largest financial obligations of the vast majority of Americans. And they're the least optimized. And then we turn, because now we have this fixed expense, we create our plans around them instead of actually making it part of our plan in a way that we are ultimately making ourselves wealthier. Is the bank going to make some money? Of course. Does the insurance make some money?
Yeah, right.
Of course.
Yeah. You had said something that made it sound like banks weren't making money on the money that's there. I'm like,
Right.
I'm pretty sure they know how to make money on every dollar that ever shows up.
For sure. And they always make money off of
Yeah.
lending. And it still, on some level, is a loan. But insurance companies wouldn't be in business if they
100%.
didn't make money. So everybody has to make money. It is just a way of, again, figure out how to control the flow so that ultimately with what you're working to do, you are looping your money instead of letting it leak out in different ways that you're owing extra money while you're making none because of how it's working.
Did you have any other specific questions at the moment? As just before we proceed, are you? Is there anything else you want to
I
ask?
think I'm good. I'm glad we went into a little bit more that it's in the insurance. So is every IBC different then? Because everyone's mentality is a little different, or is it?
Everyone will
Typically
implement
insurance.
it. Yes, you can do it with anything because it's a concept, right? You
Right.
could do it with a shoebox full of cash. It's just every time you use that cash, you're interrupting the compounding. And so that's
Well,
one
there is no
thing.
compounding if it's in your shoebox.
Yeah, that's a good point. It's inflating, right?
Right.
Or deflating.
You're
deflating.
actually
Yeah.
losing money.
Yeah. Right. And so this kind of counteracts all of those
Right.
things and allows you to operate on an uninterrupted compounding basis. And then all of the future benefit of all that, there's significant tax benefits. So it makes it makes whole life insurance designed correctly to be a very optimal vehicle to do it. But it's just a mindset.
Yeah.
Like you can do it with anything.
One of the things that's so fun about it when you get into it, so we learned about IBC 30 years ago and set up our first policies then, but it's really fun. We don't have kids, but I always thought like life insurance is so cheap for children. And if you can get them started and you can use that as a banking policy and then suddenly they're of age and you can turn that, you're a big legacy person. The episode we had you in before, we got really deep into legacy. Man, like that totally creates a fascinating legacy that like you might need a mortgage to buy your house, but if you set something up like that for their kids, they might not ever need a mortgage.
I just had a meeting with some clients who are getting each of their kids set up with $10,000 a year in for their banking system. And what this means is that one of their kids is not yet 1 and the oldest is 6. So what this means is when they all turn to about 18 to 20 and they hand over these banking policies to their kids, they'll be paying roughly around $4,000 or $5,000 a year into these policies. As soon as that kid at 18 years old writes that check for $4,000 to the life insurance carrier, they'll get the opportunity to use an increase. That $4,000 will change to about $15,000 as soon as they write that check. Now, if I'm 18 and I have an opportunity to turn 4,000 to 15, I'm excited, right? Like how much better can we do when we never interrupt that compounding?
Yeah.
It's
Yeah.
mind blowing.
So I'm sorry, I didn't mean to derail it.
No,
but
no.
Especially because it
good
was
thing to
fun
bring
because
up.
we
I
had
wouldn't have
talked
thought.
about legacy.
Children.
When you were here, that was a big part of what we were talking about. And so that is one of the things that's super cool in the because we had talked about you have to teach kids discipline and motivation and that momentum works and all of these different things. And so if you teach that in a fun way, that then you can be working on that.
Because like it's the same thing if we use, is it the 529 plans that are the college
Right.
savings things, right? So there's all vehicles that you can do things with, but if you don't go to college and blah, 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 there's all these, issues. It's the same thing. It's the discipline is at the heart of it. It's just where are we going to store it?
And those plans are siloing money.
Yeah,
They're
right.
taking it away and taking
They're-
it out of flow. And there's
Yeah.
no looping.
So they can
You lose the loop.
access it. Yeah.
Yep.
Yeah, and one more thing on that point, Kellyanne, is that even though the infinite banking concept is something that can be applied to other vehicles, if you took like the 12 most ideal account types, like or benefits for various accounts, you start comparing accounts. We know whether it's stock accounts or real estate accounts or savings accounts or CDs or life insurance. And if you apply those 12 ideal benefits to every account and you start comparing apples to apples, most accounts that you try to apply the infinite banking concept to will satisfy some of those benefits, like, 4 or 5 of the benefits, and those benefits can be anything from, tax deferred, tax-free growth, collateralization opportunity, no loss risk or no loss prevention, safe harbor. There's all these different kinds of things that goes into these account types. The only one that actually satisfies 11 of the 12 ideal benefits from an account, apples to apples account opportunity, is actually a whole life insurance policy like Kyle's talking about. And that's why the industry has applied this concept primarily to the life insurance world, because that contract on a legal basis and the way that it just exists in the financial world, there is no equal. It's just superior. And so you guys can kind of see where I'm going with this is like, I asked you questions about cash flow control. Kyle asked you questions about capital access control. Those tying back to the beginning of the conversation about the two primary functions of a bank, the intermediary intermediary function, which is cash flow control, and the lending function, which is capital access control. So where we're going with all of this is sort of the critical pivot point in the whole conversation is if the all-in-one optimizes the flow of money and IBC optimizes access to money, what happens when those two are intentionally combined? And that's kind of the interest point of the conversation that I want to go to next.
Can you say that question one more time?
I can, because I didn't say it very well.
No, it's a good question. I just want to hear it again.
Yeah. Because I started drinking the 100 proof and it went straight to my freaking head. What are you going to do next? Are you going to switch to the Million Acre?
Yeah.
I better stop drinking it or I'm
I'm going to pour a small glass.
How you doing?
I'm good.
You good?
She's still sitting there with that Million Acre going, I'm good.
So the question while you're pouring that, Kyle, is if the all-in-one loan optimizes the flow of money from a cash flow control standpoint and replacing that intermediary function of the bank, and the infinite banking concept optimizes access to money, satisfying that lending function, access to capital, replacing that access to capital function of the bank. What happens when those two are intentionally combined? So, you good with that question?
Mm-hmm.
Okay. So the next question I have is, what would it look like if somebody used the all-in-one system to maximize cash flow efficiency while simultaneously using infinite banking to warehouse and redeploy capital, i.e., start looping their money? And this goes back again to the title of the episode, Stop Losing, Start Looping. So now we're starting to enter the start looping phase of the conversation. What would it look like if somebody used the all-in-one system to maximize cash flow efficiency while simultaneously using infinite banking to warehouse and redeploy capital? Anyone?
So-
Bueller?
The thing is, again, most Americans have a pain point that is a mortgage. And it's talk about something that's in the bank's best interest. When you look at a 30-year amortizing loan and you look at how much of that is front-loaded, and then you look at how much they love to turn them because it's fixed, and therefore every time there's a drop, we're going to turn you and we're going to keep you in those, or they sell because people don't like to stay in the same house, thankfully for realtors. And so people keep themselves stuck in those early years of that cycle all the time. So how can you take something, again, it's that thing we have that we should start actually bringing into our financial plans and figuring out how to use it to make ourselves wealthier instead of just have it as a fixed expense, no different than rent if you were renting. And so the all-in-one starts allowing that to free up. It's going to manage, again, what it's using is idle cash flow, not investable dollars. So it's just using the money. You're running through your checking account anyway. And I'm a big IBC person, used it for 30 years. It's not that convenient because you still actually have to take the policy loan.
Right.
Then you have to put it in a bank. Then you have to use whatever you were going to deploy it with. Even if you could take your loan, I know I'm going to need this loan to do whatever. I'm going to park it in my mortgage and be saving all that money until the opportunity comes immediately available. And then I can super easily get the money to where it needs to be. And again, anything that's doing that's investable, then it just becomes this thing of now I have so many more options of deciding where is that capital deploying? Where does it make sense? As far as the payback, all of those beautiful things that can ultimately make you way more powerful in your overall plan down the road. And I'm sure you can see that from the standpoint of, because, you were in a traditional mortgage and you had your checking account, and where you are now, you can see that, wow, all that money that was sitting there doing nothing for me, that's now being put to work in, a year's time. Suddenly it's like, wow, that has made the biggest dent that I could have never actually made in in a traditional mortgage because I would have
Exactly.
never locked it up. It's not locked up. I could now say if I want to redeploy this money, I can. That all of a sudden, no matter what it is that you're looking to do with your money, but for certain with IBC, it just becomes this other flywheel of momentum that is ultimately.
Is that why you said momentum?
Probably.
She likes the momentum.
But momentum was with Snowball too. Like I said, when
Just
you're
kidding.
just trying to get out of debt, momentum to me is.
I'm just busting your chops.
is
I
huge.
think doing them simultaneously sounds like to me that you'd utilize the cash flow opportunity in the all-in-one, and then you'd use OPM to fund other things. So you have the control and access to capital as well as the control of your mortgage and cash flow.
I would say the only time that could become difficult for somebody is when you're weighing the cost of, do I pay interest on a policy loan to reside my money in my all-in-one loan, or do I pay interest in my all-in-one loan to reside my money in the policy?
Yes, but again, what we're saying here is that it's a different way of looking at money. So
Right.
these are people who, if they didn't have the all-in-one and didn't even have that choice to be thinking about it,
Mm-hmm.
they would have a mortgage with a fixed expense
Right.
that said, my mortgage is so inefficient because it's a fixed expense and I'm not going to put extra money into it. And I can't really put things like, I need to pay my quarterly taxes in 3 months. I can't stick them in my banking policy because I need them back. I mean, maybe I could towards a loan, but I certainly can't be using them to actually open a policy.
Why not?
So they can't become investable dollars. I need them back. I need to do that. So my $1,000 I'm going to need in a month, I can't be deploying in a way. So it becomes, again, okay, Kelly Ann has both a all-in-one loan, and then let's say she starts policies on her kids.
Right.
When her kids come of age, they never need a mortgage. So whether or not the all-in-one makes sense to them or not is an entirely different story.
Right.
Because they don't have the friction of a mortgage. They don't need to because mom set them up. And all of a sudden when they go to buy a house, they're like, I'm going to be a cash buyer. Although even a cash buyer in that way, if you're taking a great big loan, well, what does that look like as you're paying it back? Because again, even there, you're making payments, but you aren't, the ease of it is not anywhere near as easy as literally your checking account with all the bells and whistles of it. So
Yeah.
anytime you have that, again, it's weighing that out.
But all right. So caveat, I already said my IQ points are going down. So keep that in mind. But here's the way I'm seeing it in my mind, and tell me where I'm wrong on this. So if somebody is managing cash flow control through an all-in-one system, they are funding an infinite banking policy that gives them access to uninterrupted compounding interest cash value. They deploy the
Not
cap
compounding interest. Technically, banks aren't.
uninterrupted
Insurance aren't interest, they're
compounding.
dividends.
It's both.
They do, the actual policy itself makes interest. Okay.
You get a loan from your policy, you put it into work somehow, whether it's an investment real estate opportunity or something.
Mm-hmm.
That investment property makes a return. So you're increasing your income position or your cash flow position that then gets back into the checking account / i.e. all-in-one account. It's further maximizing the efficiency of the all-in-one positioning, allowing you to have a greater equity position, which allows you to do more with your infinite banking policy, which then allows the infinite banking policy to accelerate and grow, which then allows you to be able to go out and do more investment type opportunities, which then allows you to generate more income. That income then goes right back in and starts all over again, hence the looping process. Am I thinking about this incorrectly?
No, not at all. when I said what I said about where do I store my money, in the policy or in the all-in-one, it's just a real question that someone has to process. Versus if I hold a standard mortgage, it's not even a question to me whether I'm going to store money in my mortgage or store money in my infinite banking policy. Like I'm going
I
to,
see.
right? And so you're just creating an opportunity for someone to have that question.
Right.
And I've had clients who have struggled with that. And again, they use HELOCs, which is slightly different than
Very different.
Yeah, it's very different, not slightly different, but it is still a place where you can decrease your interest cost and, save on your mortgage and all of that stuff. And it does create a question, where do I store my value? Do I store my value in something I truly own,
Right.
or in someone else's system? And I'm not saying that one is right or wrong. It's just a difference. But using them in tandem, I think for the right person who understands the differences and what each tool is for, because that's all they are, is tools. Like an infinite banking policy isn't a silver bullet that's going to fix all your financial problems. And neither is an all-in-one.
No.
They're just tools.
No.
And so I think that, we can use both of the tools together to create that looping effect to go do, to bring our best to the marketplace or whatever, create more.
Well,
cash flow.
interestingly though, I mean, on one hand, I will say you talk about you own your policy and then you're taking a loan using your policy as collateral ultimately.
Yeah.
Well, you own your house. You're taking a mortgage using that house as collateral. So it is kind of like, it is still, you do own the asset. It's just using that as your collateral. So from that standpoint, and I mean, it's less about, for the person who is so far along in all of their finances where they're honestly sitting there trying to decide where they put their money, like that can be a very interesting conversation that I would love to have with them, because at that point they're like doing so well as far as all the different things and all the different ways they could be deploying capital. Like deciding which to pay back is honestly the like the easy part, right? Like the fun part of let's run through numbers. It's again for the person who mortgages, like for most Americans, are their largest obligation. How in the world do you do it better? How in the world do you not have the siloed thing that you've stuck over here because it's the payment I have to make? And then you don't pay any attention to it. And you never even pay attention to, oh my God, even at a 3.5% mortgage over 30 years, the amount you paid in Ingrid would probably make you freaking cry. So if there's a way to do that more efficiently, because you do have the mindset, I mean, you're pretty much only going to do an IBC if you are the saver mentality. At least you're only going to do it well. Otherwise, you're going to set up a contract and then rape it, and then that's not going to be good. You are only going to do well on the all-in-one.
I disagree with
Give
that.
him a chance to respond, because because I don't think he agrees.
Because that's a strong statement. And maybe I've just clarify what you mean by a saver mindset. What do you mean by that?
So somebody who's actually responsible with their money.
Okay, that's
They are
totally
gonna
different
set
than
up
a
policy
saver.
and then immediately pull all of it out and go, okay, like I set up this policy and I'm going to take it all out because I, like, as a loan against it, which I never plan on paying back because I'm not responsible enough to do that.
Yeah. No, I agree with that. Someone who's responsible with their money. Now, I wouldn't define someone who's responsible with their money as a saver for general.
That's true.
Okay.
I agree with that
'Cause
because
that
unfortunately,
implies, like,
saver
hoarding.
is the concept. Yes.
Low risk.
Saver
Right.
is the
Traditional.
concept of the
Yeah.
person who is actually. Yeah, that's true. That is a good point. That
So there's
terminology.
the
but
spender and the saver is what we
Responsible.
typically think of.
Let's
Yes,
just say
but how do we?
responsible.
Yeah,
let's
the
just say
investor.
the responsible person is the one doing the IBC.
Yeah.
You're only going to qualify for an all-in-one if you are the responsible person. Like that is it. You have to be responsible with cash flow. And so there, at that point, there doesn't become like, I would never say, oh, do this so you can like take all the equity out of your home and throw it into a policy, because that's not like, that probably would not be a good idea. But if you already have a mortgage that's a pain point, and we can put that mortgage into a better position for you, because it becomes more efficient and your idle cash dollars become more efficient and ultimately save you money, that means you can actually use that other vehicle and maximize its benefits and maximize your ability to capitalize it and everything else, because you've shored up that pain point.
Yeah, there's no question whether or not the way that we do finances today and have for so many years is creating pain for so many people.
Yeah.
No question.
Yeah.
Just out of curiosity, I just thought about this. How do you think if your dad were part of this conversation, what would he say?
This is very conceptually sort of how my dad thinks. And maybe he's never used the term IBC to me, but I wouldn't be surprised if he's pretty familiar with it because he does like to use leverage and other people's money to invest and have that be an opportunity for us to make money. And they're going to make money too, obviously. But he retired. I think we talked about this the last time. So he was literally like going to get a mortgage while he still had his income, W-2 income, because you can,
to make sure he could tap into leverage.
Yeah. And he's getting up there in age and those kinds of things. So for him and I, especially if we were looking at doing another rental property together, some other kind of investment, we are automatically kind of have to go out of the box because we don't want to use all of our own capital to fund something. So this would be interesting. It almost seems like the people who can utilize the all-in-one are the same people who would deploy the vehicle of an IBC.
Right.
Mm-hmm.
Because we do have to go to a third party and ask for money, and then they need to kind of vet everything, which is always a process. But if we owned the entity that had capital that we could lend for a specific purpose or investment, and then all of it makes money, I think that's a win.
You obviously are familiar with the all-in-one, and you've heard a little bit about the infinite banking concept so far. So do you feel like they're more synergetic or redundant?
I think both, depending on the type of person and what they want to do. I think, like you said, my kids might not have to get a mortgage, but would they want to get a mortgage?
Right.
Do you know what I mean?
Sense because
are they going to go buy another house?
Right.
And have two houses and have, one become their asset and equity in that house, and then have another be, an investment property or, another real estate holding or what have you. So I think for the person that doesn't want a lot of risk, or they don't have sort of the time or the mental energy to sort of look at investing in another way, I think maybe just the all-in-one. And then same thing, if it's someone who's not going to qualify for an all-in-one for whatever reason, they don't own a home, maybe they kind of live remotely and kind of here or there, or don't have the equity, or a partner that's not on board with it, then maybe something like the IBC makes more sense. But I think not to generalize, but I think maybe for people like us, people like my dad that want to do both,
right?
I think they could work synergistically.
Yeah. Well, and Kellyanne was really fun because the concept of the all-in-one, and she was like, I was like, I feel like this fits your needs, when she came to me and was like, okay, these are the things we want to do, blah, blah, blah. And I was like, I feel like this would be an amazing product for you guys. And we ran through the simulator and it looked good. And she's like, let me think about it. She went to her dad, and her dad, they spent a ton of time in Australia.
Yeah.
Well, Australia, a lot of different places, this is how mortgages are done. They are done more as like this line of credit collateralized by your home. And her dad was like, oh, like, this is brilliant. Like, I'm so excited somewhere in America actually has this, because this is how we did mortgages in Australia. So
and
it
in
was
Europe.
really fun to talk to her about that and hear that as feedback of like, for some people, it's like, it just makes sense. But,
I think
all been sold the
if
30-year
Australians
mortgage for forever.
went through what a typical 30-year mortgage looks like with the front-loaded interest and how much they pay, I mean, they would be outraged. I think he even said like some terms are illegal there that, we get by with based on our banking system.
Well,
here in the
Congress
States, but
authorized the 30-year mortgage in 1954 because they were going to make houses more affordable.
Look, I lived in Australia too, and I love the Australian people to death, but I would question whether they would whether they would raise an eyebrow at what you just said, because they did turn their guns over. They did hand their guns over to the government.
True. Yes.
So shifting into the freedom implication of the show, whiskey,
That's
wealth,
true.
and freedom, right? So we've touched on.
Give up a lot.
We've talked on our whiskey. We've had our whiskey conversation. We've had a wealth conversation. So I just want to bring things to the third part on the freedom side of the show.
You can have an IBC, an all-in-one, and your guns.
Yes.
In America. We're the best.
America's crazy. Let's all be real about that. America's crazy.
And the best.
Yes, I love living here, man. I wouldn't live anywhere else.
Now I gotta run back to Montana. I had my fun